Nasdaq. For this episode, we're going to focus on alternative investments with Bruno, who's the Chief Investment Officer over at IndexIQ. Sal, thank you very much for joining me live over at MarketSite. Let's talk about what are alternative investments and how do investors use them?
So alternative investments are any investments that have lower correlation to the traditional stock and bond markets than you would think of from a traditional long-only mutual fund. And those lower correlations derive from a number of different ways. Sometimes it's just the intrinsic nature of the asset class that's being invested in. So for example, things like commodities and real estate tend to have lower correlations just because the very nature of their businesses are a little bit different than stocks and bonds. There are also ways to create alternative investments using stocks and bonds, but actually packaging them differently. So for example, you look at a market neutral type strategy, it's investing long in some stocks, short in other stocks, but there are different drivers. So they're trying to neutralize the market effect, thereby driving down the low correlation to the equity markets. You could also look for groups of stocks that have other catalysts that aren't driven necessarily by the direction of the market. So it might be, for example, a merger arbitrage strategy would be something where the drivers for these stocks are not really the direction of the market. It becomes sort of, are these deals going to complete or not? So you're looking for assets or things that are driven by something other than the stock or bond market.
I mean, how did this perform in 2017, and what's your outlook for 2018?
So when we look at alternatives, we sort of set a frame of reference, a benchmark, almost sort of 3 to 6% over the risk-free rate with low levels of volatility. If we look at the different hedge fund indices that are out there, they're running at about 5.5 to 6.5, maybe 7% total return on a year-to-date basis. If you take out sort of a 1% average short-term interest rate for the year, they're running there about 4.5 to 5% over the risk-free rate, which puts them very comfortably in that 3 to 6% target range where we like to see hedge funds and alternatives perform. Our outlook for 2018 is actually pretty much the same. We think that given where the markets are right now, where we are at the Fed cycle, we think it's actually a pretty good environment for hedge funds to continue to perform well.
Well, tell us about some of the products that IndexIQ has and how did they perform relative to others within the space?
So IndexIQ has been a pioneer, one of the leaders in developing liquid alternatives in the ETF form. Our first fund came out, our first ETF came out in 2009, March of 2009. It's the IQ Hedge Multi-Strategy Tracker ETF. The ticker is QAI. It's one of the largest and oldest alternative absolute return ETFs out there with almost 1.1 billion in assets. This year, when we talk about our 3 to 6% over risk-free, we're up about 5.5% or so, plus or minus, on a year-to-date basis, which also kind of puts us comfortably in that 3 to 6% range. QAI is based on the concept of hedge fund replication. So we're not actually investing directly in hedge funds, but we analyze the returns of hedge funds, and we identify the factors that we think are driving the majority of the returns. We try and invest in those factors using liquid proxies like other ETFs. And so really it's a synthetic multi-strat fund of funds. It's sort of synthetic because you're not actually investing in hedge funds. It's multi-strategy because it covers 6 different hedge fund strategies ranging from market neutral to long short to global macro. And it's sort of a fund of funds concept because we're not trying to track any individual manager. We're trying to sort of get the average for a group of managers within each of those particular strategies.
Right.
And so its performance has been online with where we're expecting it, being relative to the target. Our other large ETF, are sort of our fastest growing this year alone. It's raised over 100 million in assets, has been M&A. And as the ticker implies, it's a merger arbitrage ETF. And as opposed to QAI, which is trying to go into sort of factors that are driving hedge fund returns, this one's more of a mechanical implementation of a hedge fund strategy, particularly merger arbitrage. So we're actually buying individual companies when they're announced as being targets for an acquisition. And we put some hedges on to try to mitigate some of the downside risk associated with the acquirer.
Okay, so my question is to you, how would an investor use these? And with them being ETFs, it allows the average investor to have exposure to hedge fund type strategies where they wouldn't get it on their own, right?
Exactly.
So I also want to take a look at a quick chart so we can see how the performance measures up. But explain to us how an investor might use these in their portfolio along with the chart.
So despite a lot of the headlines that kind of the big return hedge funds get, most hedge funds are designed to sort of mitigate risk and mitigate downside volatility. And that's what many of our strategies are designed to do. And if you look at sort of during the worst crisis we've seen over the last 15 to 20 years, obviously there was the TMT crisis in the early 2000s. And if you look at the chart and you look at hedge fund indices during that time period, they protected very well as the S&P was down. Strategies like merger arbitrage and market neutral actually did very well, and some were actually even positive during that time period. Obviously, the crisis in
Right,
2008.
you saw the same thing for that.
We saw the very same
Right.
thing. These were down. They didn't quite have positive returns, but they were down, but not nearly as much as the equity markets were down. So that's really, we think, the way that investors should be accessing or should be using alternatives in their portfolios to minimize the downside. And we think ETFs are a great way to deliver that because, as you mentioned, the access that it gives, you don't have to worry about accredited investor rules. They tend to be more tax efficient because they're in the ETF structure. The price point is a little bit more attractive. You don't have any performance-based fees. And of course, you have the intraday liquidity and full transparency into the holdings. So there are all of the benefits of an ETF with the benefits of sort of getting hedge fund-like returns.
All right, well, thank you very much, Sal, for joining us.
Thanks, Jill.
And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.